Welcome back. Well, let's focus on another stock that's done very, very well, GE Shipping. Well, the quarter one numbers, we saw good growth in revenue and profits. Margins as well are holding around the 60% for the second consecutive quarter. To understand the way ahead, we're joined by Mr. Shivakumar, the ED and CFO of the company. Hi, Mr. Shivakumar, and good morning, and thanks a lot for joining in. Well, prima facie, it appears that spot shipping rates are softening a tad bit. Could you comment on that? And also, if you could give us the split between spot as well as longer-term charters.
Good morning, Nigel. Thank you for having me. In the last quarter, if you're referring to the last quarter, yes, we had a slight drop in crude tanker rates vis-a-vis the previous year, corresponding quarter in the previous year. But we had product tanker rates being higher versus the previous year. We had bulk carrier rates and our gas carrier earnings being higher versus the previous year. Currently, rates are significantly lower than they were in the first quarter of an FY25. This is likely to be the usual summer lull. Tankers traditionally have been weak through the Northern Hemisphere summer months, especially July to, say, October or so. So currently they are weaker than that also. We don't see this necessarily as an indicator of rates to come or the strength of the winter market for tankers. Bulk carriers, of course, are stronger because they have the opposite seasonality. In general, on the fundamental side, we are seeing a slight drop in demand growth for oil being a little lower than was expected at the start of the year. China was pretty weak in the last quarter in terms of crude oil imports. These are slightly worrying signs. But again, we see these ups and downs even in the midst of a strong cycle. So we shouldn't read too much into it.
Okay, all right. And since the order book, is still low, I think, that should support the rates in a longer term, say for the next 2 to 3 years, or that's what, most analysts are saying. Also, the split between spot as well as longer term, what is it at currently?
Yeah, so it depends on the sector. In dry bulk, we are 90% plus spot. In LPG, we are 100% fixed. We are on 1 to 2 year charters for all 4 of our vessels. In crude, we are 100% fixed. In product tankers, we are about 30% fixed on our fleet. And when I talk about fixed, I'm talking about for the next 12 months.
Sorry, let me just get that again.
Exposure. Even product tankers, while it's 30% fixed, the product tanker fleet is very large as a proportion of our total fleet.
I see. Just to go back to Mr. Shivakumar, hi, good morning. Just to go back to that slight drop in demand that you spoke about. Last night we got we got PMI numbers, and it's an early indicator, and it seems to be the first kind of synchronized slowdown in global manufacturing that we are starting to see. First signs emerging. So are you picking that up as well in your conversations, etc., or too early?
Yeah, the data we've seen, and also because China is one of the big factors in commodity imports, we've seen data for China specifically, and we can see it, we track it through the import data itself. And as I said, crude imports were down about almost 1 million barrels a day year on year. It's about 9% year on year into China. Steel production has been lower, so that's affecting the dry bulk. While iron ore imports were pretty strong, we are seeing steel production being slightly lower, and in fact, exports, consumption being even lower than production, which meant that there were steel exports coming out of China. So all of these are a little bit negative for the markets in terms of the underlying economic strength or which could drive the markets.
And how important, China, of course, from a commodity point of view, is the single biggest incremental driver for shipping rates and for your business. What would sort of further weakening of that market mean?
Yeah, so just to put it in perspective, 40% plus 44% of dry bulk trade is China related, which is either imports into China or exports from China. 20% plus of the crude tanker trade is imports of crude oil into China. So this is a very big factor. And as you know, we live and die on the margins. That 1 to 3% margins make a big difference on demand-supply balance, make a big difference in the rates that we earn.
Okay, all right. Wanted the updated pricing on rigs as well. I think, there is one, or I think there are a few more actually that have to come up for repricing. So could you break that up for us? How many have already come up for repricing? And how many will come up? And how much is it likely to be repriced at?
Yeah, so first, the last question. It's a tender business, so we don't know what they'll be repriced at, and it's tough to forecast. But we had 2 rigs coming up for repricing in the second half of calendar 24. So they will come off contract within the next 3 to 5 months. They're coming off 3-year contracts. Both of these were bid into 3-year contracts into India, in India itself. Both of those contracts those tenders have expired with no contracts being awarded. So they've effectively been cancelled. Now we are waiting for the next tender to come out because we assume there is a requirement in India. So we're waiting for that to come out. In the meantime, we're also looking at other options, whether we can do some short-term contracts in India itself. There are other opportunities. We're also we used to focus on doing long-term contracts in that business because we had taken a little more debt in that business than we do in shipping. So we want to de-risk that business, at least de-risk that debt. Now we are very comfortable in the offshore business. We are also looking for shorter term contracts, and we are very comfortable doing short term contracts as well. So we don't have an update on the pricings. Ever since Saudi Aramco off-hired, I think 24 rigs in the month of April, May, there has been a little bit of uncertainty in the international markets. However, we haven't seen pricings drop in terms of day rates. So it's still early and we are not able to tell what could happen to day rates yet.
Okay, well, thanks a lot for that. Appreciate your time here on CNBC TV 18. Well, that is the word coming in from GE Shipping. But moving